Thank you for joining the Learner Group's monthly recording. And we're going to do a little different this month. We're actually holding our first in-person event as well. First time in 2.5 years. So we thought we'd recap some organizational changes that we've had during the last 2+ years. And the first one is very exciting, is 3 new partners to the firm, which happened to all 3 be on this call. Megan, Michael, and David have been with the team collectively each almost a decade or more. And it's exciting times as we've seen the growth and development, growing with the 3 of you. It's been super appreciative. Clients, families have benefited, have all seen the growth as well. So it's really a great time for the firm as well as the 3 of you to all join as partners. So it's, congrats to the 3 of you, and exciting for the firm and all the clients and everybody listening.
Thank you, JR. I think I speak for all 3 of us that we are very excited to be in this position, and we're very grateful to you, to Ming, and to Jean as well for sort of leading the way for us and helping us to get to where we are today. And our success has also been not possible without the rest of our team behind us. And speaking of the team, over the last 2.5 years, we have had some new faces that we've added. Starting out in Florida, we have Melissa Wheaton, who joined us as a new estate and wealth planning specialist, a new estate planning attorney to complement Wayne Cooper here in Deerfield. We also had Tim Karaposki added. He came over, I think, a little over a year ago as a private wealth associate. And one of our newest additions, Ron Eisner, he's a new wealth advisor based in Florida as well. And then back local here in Deerfield, we had Max Miller join, I think, last week or 2 weeks ago as a private wealth associate, as well as Matt Ward, who joined about a year ago as well, as another private wealth associate. He follows the trend of former interns becoming full-time employees with us, so we're super excited for that. And then we also had Camille Houston, who has been with us for, I think, almost 2 years now. She joined us and is becoming our office manager, and I think it's been great. And then Megan, you want to talk about some of our junior associates?
Yeah, so we have introduced some very young associates that are coming on in the next couple decades. But so the leader of the pack is Shay Schneider. So he was born 2020, right in kind of the middle of everything, and he has been doing really well. Matt Taylor's son Will was born next, and then we have little Izzy, which is Michael and David get this a lot, but this is actually David's son. And then Callum, which is my son. So we have a boy trend coming. We'll see what happens next. But yeah, we have a lot of new dudes that joined.
And then as far as, promotions and some of the other folks that I think, like Michael said, it really is a team effort, and a lot of the team has stepped up throughout COVID and really since. And Jamie, who's really taken over and has helped streamline and improve operations. Maris, who's really helped improve our overall project management, and kind of some of the things that you're seeing being rolled out are really her efforts. Camille, is a new addition, and also, has become an office manager, really focusing on making sure that things are operating smoothly. And then Dee, who some of you have spoken with, has become an analyst and really focuses on both the fixed income as well as the equity side. And then lastly, Sylvia, who I think you've seen a lot of her efforts through our marketing, and has really helped us go to the next level with that. So our team, outside of just the new faces, there's been a lot of folks who have demonstrated their capabilities and have really stepped up during this time.
And one new update that some of you may already know, but we have officially opened an office in Florida as of last year. So the thought process behind this was we've had so many clients that have already moved to Florida or might be part-time living in Florida. And so there was a real need growing. Almost 40% of our book now resides either permanently or temporarily in Florida. So just for one instance, we wanted just boots on the ground to be able to better serve our clients, but also just expanding our footprint, not just between Illinois and Florida, but just generally across the US and nationwide. We're looking to better serve everyone. and establish physical presences where we see a good fit.
And then on the theme of what Megan mentioned, if you look back at our team's history and some of the things that we've done over the last number of years, we've really evolved and focused more around the planning capabilities and organizing and streamlining your financial life. So a lot of the things that you would have seen in recent years would have been the streamline of the net worth statement, which helps you get a better understanding of where all of your assets are and kind of answer the question of where you are today. But then really moving forward with financial planning and trying to give you the answer of where you're likely going to be and how you plan for that future, so that it is actionable for you and becomes more specific as opposed to kind of general market commentary. And then looking further ahead on the estate side, Wayne, and then also with Melissa recently joining, we've focused on estate reviews and identifying opportunities to help pass along some of the structures and wealth to the next generation, make sure there's financial literacy and that they understand how everything works, and then be able to meet your goals as well. And then lastly, on the legacy, it's kind of bringing it all together. So kind of the reason why you're doing all of this and really making sure that you're not just passing down the money, but also the values and the intent and the structure as well. So those are some of the things that we've done, and we're very excited about that. We've seen a lot of impact from it, but looking ahead, there's more capabilities that we'd like to build. So as we look to 2023, it's going to be really building out some of the family office capabilities and focusing and going deeper on a lot of the areas that we mentioned, but also putting some structure around it so that there's a coordinated approach to the wealth management with estate coordination and building in the legacy side, but then also addressing some of the more lifestyle items as well as charity and philanthropic giving. So more to come on that in 2023. And then with that, we can maybe shift a little bit over to the market commentary. So it's definitely been a volatile couple of weeks, but JR, do you want to maybe kick us off and talk about some of the things that we've seen in recent news?
Well, even before we get there, David, the investments are critically important for families, but we've really recognized over the last decade the importance and the growth of the business as we recap the last couple of years is the importance of including everything as well as investments. So as you walk through, David, kind of full turnkey for your entire family multi-generationally and integrate. And that's where the resources, the hires we continue to make as we grow is to evolve with your family as we continue to change, right? And we'll continue to try to stay ahead of where things are going, both on the estate planning, financial planning, and the markets. So as we turn to the hot topic right now, which are the markets and all the volatility we've seen here really for the last 9 months, nothing really is new from the standpoint of that volatility. It's just taken maybe another opportunity to add some volatility recently with the Federal Reserve. And maybe if you start with kind of Jerome Powell, maybe some of the quote and thought that's come up this week with the Federal Reserve raising interest rates again. And it really comes to, if you look at the title of the slide, don't fight the Fed, right? And we talked about this starting the year on the challenge. It was going to be a more difficult year, but it just continues to be ever changing as inflation remains sticky, at least from the Federal Reserve's viewpoint of the way they're watching it. And when you look at a couple of the quotes, we need to put meaningful downward pressure on inflation, right? There is no viewpoint on how good things are with the labor market and other things. The Federal Reserve remains solely focused on bringing down inflation. And that just continues to cause angst in the market because the economy that's itself is not really in terrible shape. We continue to be flatlining in a lot of ways. There's some good, there's some bad, but the Federal Reserve is solely focused on that inflation number. Mm-hmm. And that's really kind of become front and center from last week when the CPI numbers came out. We saw the 1,200 point down day in the Dow Jones, and it's just brought the volatility kind of to another level as we sit here today.
And I think the volatility is also because although the rate hike, even at 75 bips, was not a surprise, it was more of the tone that they're taking moving forward, that they're okay potentially triggering a recession or recession-like events that could follow. And their main focus is truly just tamping down inflation. So with some of the language that they used, I think that's what more triggered the volatility, although it wasn't a surprise moving forward.
Let's maybe look at Michael, if you want to recap the Federal Reserve rate hikes this year, and because a question on a lot of people's mind is how far along are we? How much is there to go? And maybe kind of recapping, because a lot has happened on the Federal Reserve accelerating rate hikes this year.
Sure. So, the first rate hike, as we pull it up here, you saw a 25 basis point hike in March. That was really to get us off zero. Everyone was expecting that, and you see that after had that hike, that you did see the S&P really rally after that. And as we got into the rest of the year, in May, you saw the 50-point hike, and then as we really saw inflation, pick up, not slow down as everybody was hoping, that's when in June the Fed put in their first 75-point rate hike, and then again in August they did, or I should say late July, did another 75 basis points, and then this week they did the other 75 basis point hike. Again, as Megan said, this is really about tampering down inflation as best as they can. And as we look ahead, the Fed looks as though they'll probably raise another point to 1.25 points the rest of this year, and maybe either 75 basis points in November and then 50 in December, or vice versa. And if we're looking at a silver lining, that could be that that's really where the end of the rate hikes are going to be, that the Fed wants to sort of really get this all wrapped up before next year. And so if that's the case, it can really give us more of a time frame of when we'll start to see companies really adjust to where rates are going to be, and really start moving their businesses based off of that. Because really, once you have more certainty, and when companies have more certainty with what their own finances are going to look like, how much it's going to cost to operate their business, that's when they can really start making real decisions for how to move forward within their companies.
And now that we've seen these rate hikes, what's the advantage here, right? I mean, there's definitely positive from an investor perspective with where interest rates are. And maybe if we recap where we were in 2019 to now, and some of the advantage, because it feels bad for what has felt like the losses of the last 6 to 9 months. But when you take it in context a couple of years and kind of resetting expectations that we've talked about this year, there is some positive as we look forward in this.
Yeah, I think if you kind of started 2019 and then work your way through today, there's a number of things that have changed. One is just the overall level of where market indexes are, and then where portfolio values are. And then the second component is what's the potential income that you could generate. So we talk about the 60-40 portfolio, and that's gotten a lot of kind of conversation recently around this is the worst year potentially, right, for a 60-40 portfolio, because you see that equities are down, bonds are down, and so together you're not getting a huge benefit from the diversification. I think bonds have performed obviously better than equities, but that being said, still been a difficult year. But if you kind of rewind and see where you would have been a couple years ago and where you are today, so if you started in 2019 with a 60-40 portfolio through today, depending on if you were in the S&P or a broader index, combine that with a bond fund, you would have made about 57% over the last 3.5 years. The other thing that would have changed is, so you would have went from about $1 million to 1.57 million in your equities and bond portfolio combined, and that's through this downturn. So putting things into perspective, significant increase over the last couple of years. The other thing I think that's important to point out is the interest rates have changed significantly. So if in 2019 you had $1 million portfolio and you were to put that all into fixed income, you could generate about 4%, just given where interest rates were, 4, maybe 4.5%. So you're looking at about 40, maybe 45,000 of annual income. Today, with interest rates being much, much higher and your portfolio value being higher than it was in 2019, you now can generate about 6.5% on $1.5 million or slightly more. So what that's done for you is, one, you've taken advantage of the growth over the last couple of years. Obviously, you would have wanted to rebalance and shift slightly to fixed income, which is what we would have continued to do along the way. And then now at this point, you're able to lock in significantly higher interest going forward. So your income and your purchasing power on the same portfolio, essentially from 3 years ago to today, went from about 40,000 to maybe about 100,000. So it's a significant increase in the amount of income you stand to generate. And these days, with higher interest rates, your portfolio can generate a lot more income for your financial plan than you could have done over the last couple of years. So you're in much better shape as you're kind of heading into potentially retirement or looking to de-risk your portfolio overall.
And as we look at the why of interest rates and recap maybe to inflation and kind of watch, we've been looking at the monthly changes, and the recent numbers of the last couple of months have been very, very favorable. It's just you have a lot of big inflation numbers are going to take some time to roll off over the next 12 months. And, you know, Megan, as we're looking at the inflation here and near term, it looks pretty good. I mean, what are some of the rebalance opportunities, as David's saying, to get through the volatility? Because we always talk about crisis investing and what to do and trying to keep things in context. And I think looking to the improvement of this over time, what do we do as we're thinking about the portfolios right now and what's ahead?
Yeah, and I mean, as overall, we're continuing to build cash. So that's something we'll proactively continue to do on our end. But also in the meantime, it's okay to just pick up yield and wait it out. So as we continue to shift towards bonds right now, we're at least building yield on that end and waiting this out. So your return overall might be muted compared to the past couple years, but at least it's not going to be as affected on the downside as it otherwise would be. So that's kind of what we're thinking. And as the Fed keeps hiking rates, we should see those numbers continue to rise from that side. So that's where we're going in the near term.
And when you think about, Michael, on, you know, I always talk about you can't time the market, meaning you go all the cash right now because the outlook's a little gloomy. And it sounds really easy to say the outlook is uncertain. Let me just sell everything, wait it out, and I'll buy when it's clear, right? I mean, it sounds easy. It makes you feel good in the short run. The reality, it just does not work. We always talk about timing within the market, that you can make the adjustments, whether it's the bonds. Now we think about the equity side of the portfolio, Michael, on maybe some changes as being able to efficiently raise cash without really taking a huge reduction in principal. Maybe some of the strategies we're thinking about and have executed throughout the year.
Sure. So some of the things that we've done, again, as we look to get a little bit more conservative right now, is find the names that have a little bit of a loss and a little bit of a gain that we feel are still, good names, but might have a bit more risk in the near term, that as we can sell out of those positions, not really add much from a realized gain perspective, is that's been a way to add some extra cash to portfolios. And then, as Megan was saying, to kind of tie it in with some short-term bonds that we can generate some yield, have the safety of the principal to really redeploy when it does start making more sense. And other things that we would look for from sort of a timing market, like sort of timing within the market, and is to really say, all right, when we start to see some of the trends changing, when we could start seeing a bottom kind of really form in the market, what are we looking for? And some of the things that we would look for are when, say, small companies start really outperforming large companies. And the reason that that's a bit of an indicator for us is that small companies are generally more volatile, they're more risky, there's just fewer shares available to the public. So when we're looking at sort of reasons to be optimistic, if we are seeing that more investors, more managers are putting money into small companies, that's more of a risk-on view that we're seeing in the market. So that's something that we could look for to really, time within the market, as you were saying, JR.
And again, looking for signs, like you said, Michael. The other thing you tend to see in the last leg down of the market is the biggest of the big companies really fall a lot. And you've seen that recently, where the big 9 in the S&P, a lot of those have been the leaders downward in the last week or so. And again, it's a contrarian sign that we're getting closer. The other thing we'll see ahead is more bad news, right? And the bad news for now is taking the market lower. But over the next few weeks, as you start to get bad news, a lot of it starts to be priced in. And as the market starts to actually go up on some of those negative news, these will be other things to look for, because the bad news will mean the Fed's closer to the end of what they have to do, is in general the translation. So it's just this weird dynamic that plays out, that we want to see bad news and then, you know, we're closer to the end. So it's just going to continue to be a volatile market. But these are the strategies we've deployed over the years in times like this, that you just have to have a little more cash and certainty to protect, because things could go lower. And on the other hand, there's opportunity out there, and you need the cash to take advantage of that opportunity that is there today and waiting for the right time. And meanwhile, you got short-term interest rates at the highest levels in 15 years. So you can get short-term treasuries at 4%. So it's not a bad time. You're actually getting paid a little bit to wait, and it gives us the flexibility to move as needed. And there will be, and there is opportunity right now. It's just staying patient and riding it out. And then as you think about the needs, build the cash flow, right? If you need $10,000 a month to live on, or $20,000 a month, or whatever that number is, it's a good time with interest rates up and dividend yields up to be able to lock in a lot of those income to ride through times like this. And it was one of our biggest lessons learned from 2008 and 9. It really helps to focus on that cash flow and build that cash flow in times like this, because it helps to protect, and it really helps your mindset to kind of ride out. The portfolio is generating more than you need, I'm okay. So with that, maybe we turn to a couple of the planning topics as we close the meeting this month on some things that are out there and some changes, you know, to next year, David.
Yeah, so I think a lot of, you know, when the market's down, it's kind of counterintuitive, right? As the market's going up, people like to add, and then as the market's going down, it's really the opposite. But that's the time to be thinking about planning, and particularly strategies. So some of the things that are happening now is, one, with this record increase in inflation that we've talked about as a negative, there are some positives. So one, looking ahead to next year, the ability to gift is going to increase. Two, the lifetime exemption per person is going to increase by about $800,000. So an additional $1.5 million for a married couple that could be gifted as a result of this increase ahead of the 2026 sunset. And even after that, it's still at an increased rate. So I think those are two things that there's a lot of opportunity with. You know, we've talked a lot about putting growth outside of the estate, specifically with spousal lifetime access trusts and other vehicles as well. That's a good conversation to have with your estate planning attorney. But again, as you're trying to put some of the growth outside of your estate, particularly at these lower levels, it creates a great opportunity. And then, you know, lastly, we've talked about this kind of since the start of the year, but it's becoming more and more relevant now, is you know, things like Roth conversions, where you're able to convert shares, move them out of your IRA, lock that in at a lower amount and tax rate, you know, kind of reduce and avoid future required minimum distributions that you may have to take, and then again structure all that growth to be tax free in the Roth. So there are, you know, in a down market, there are a lot of planning opportunities and a lot of things to take advantage of. So it's definitely a good time to catch up and kind of go through some of those things that are out there. But there's definitely a number of options that people have and should kind of keep an eye on through the rest of the year.
With that, we kind of want to thank everyone for tuning in, getting the updates. And again, with times like this, it's unnerving for everyone. It is a good time to check in on your income, check in your financial plan and needs, make small adjustments if needed. But other than that, it's just a matter of staying patient and getting through this, as we always do. But these times are difficult, and that we want to thank you for tuning in, and we'll see you all next month.